5 years ago, I was fully invested in stocks and bonds. I thought I was doing the right thing, but when I checked my portfolio, I was shocked. My rate of return was 2%, and over the previous 5 years was a measly 5%. And that's when I decided to drastically change my investment strategy. In this video, I'm going to tell you exactly why and how I did that. I'll be sharing my exact allocation strategy for my stock portfolio and my real estate portfolio. But before I get into my new portfolio, let me first give you some background to explain why I made such a drastic change. It was 2021. I was burned out and exhausted from years of working ER shifts and dreaming of working less. So I opened my retirement account to check to see if I was close to my goal. And instead, I saw that painful 2% return. Like many of you, I've always heard just invest in the stock market. The average return is 8 to 10%. You'll be fine. So why wasn't it working? Well, every investment strategy has its limitations. And I had not taken the time to understand these limitations previously. And that's why I was frustrated. So before we get into my current portfolio, let's take a look at some of the factors that affected my returns. First is market volatility. Markets go up and down, and those swings reduce your returns because compounding works both ways. If your portfolio drops by 20%, it needs to gain 25% just to recover. This volatility drag, as we call it, lowers your returns. Let's look at an example. Let's say year one, your portfolio value is up 30%, and in year two, it's down 20%. The average return should be 5%. But now let's look at the actual growth on a $100 investment. In year one, that $100 goes up to $130. And in year two, that $130 takes a 20% hit and is now $104. So the actual return over 2 years is 4% or 2% annualized, not anywhere near the 5% that we expected. This is the difference between average returns and actual returns. The more stock prices fluctuate, the more it erodes our compounding over time. And this is something I've considered heavily as I built my new portfolio, but more on that in a moment, because the next issue that really affected my returns is over diversification into bonds. Diversification is a good thing. However, this can lower your overall returns if your diversification strategy is to split your investment dollars between stocks and bonds. Bonds are definitely more secure, but they lower your overall rate of return. Let's look at this table that shows typical historic returns for a stock bond mix. As you can see, if you were 100% invested in stocks and expecting a 10% return, as you increase your allocation into bonds with age, which is what is recommended, you are going to see a significant drop in your overall return. Now, the third thing that most likely affected my returns were fees. The returns cited for the stock market do not account for fees, and even 1 to 2% can cost hundreds of thousands of dollars over time. Let's look again at an example. If you invested $100,000 at 8% and you add $10,000 annually over 20 years, a 3% fee versus a 1% fee results in a difference of over $200,000. All of this combined meant one thing: I was not on track for retirement, and that's why I decided to change my entire investment strategy. Now my investment portfolio is 75% stocks and bonds and 25% real estate. I'll get into the real estate part a little later. Out of the stock and bond portfolio, 40% is in a target date fund through my employer, which has limited options. The other 60% is in an IRA that I manage more actively. And because I wanted to revamp my entire strategy, I consulted a wealth advisor to get some insights. He asked me a couple of key questions before making his suggestions, and you may also want to think about these questions whenever you invest. First, he asked me, what's my time horizon? Investing in the stock market requires at least a 10-year horizon, meaning that you should only invest money that you will not need for at least 10 years. The time you can remain invested also impacts how aggressive you can be. For instance, if you have 20 or 30 years, you can afford to ride the market's ups and downs. However, if you're only 5 years from retirement, you need to protect your capital and invest more conservatively. The more time you have, the better, because investment values compound. So in my case, I said I had at least 10 plus years. The second question he asked me is, what is my risk tolerance? And I told him I'm comfortable with moderate risk. I don't check my accounts obsessively, and since I'm still working and I have real estate as a non-correlated asset, I can tolerate some risk. So after some conversation, he looked over my portfolio and recommended these funds. So these are the funds he recommended in this distribution: the Vanguard Growth Fund, the Vanguard Value Fund, Vanguard Mid Cap, Small Cap, International ex-US, International Dividends, and some emerging markets. And now these are all ETFs, no individual stocks, because I wanted something simple that I could manage. And these are all diversified across cap sizes and regions. Quick tip, CAP stands for market capitalization, the total value of a company's outstanding shares. Market cap is calculated by taking the share price times the number of shares. It's a quick way to measure a company's size and value in the market. And the common categories are large cap, mid cap, and small cap. And here's a table that shows you their average value and the types of companies you would expect in each of these categories. Large caps are good for stability and long-term wealth building. Small caps are better for those seeking growth and willing to accept more volatility. Now, in addition to my stock portfolio, I decided to invest in real estate. The key features of real estate that appeal to me are: first, it's a tangible physical property with intrinsic value. Secondly, it's a hedge against the stock market volatility. Real estate values don't fluctuate daily as the stock market. Third, it's a hedge against inflation. Real estate values are tied to rents, so values keep up with inflation. Now, my first plan was to buy single-family homes as rentals. However, in 2021, home prices were really high and expenses, taxes, insurance, and maintenance were also high. And I knew that market appreciation is unpredictable. And I also realized that one tenant could determine the success or failure of the entire investment, especially if the margins were thin. Furthermore, I would carry all the financial liability. And then I learned about passive investing through commercial real estate syndications. A syndication is a partnership in which investors pool their resources and skills to invest in large commercial properties. The general partners manage all the details and make all of the decisions, and the limited partners bring equity or money for the down payment to finance the property. The size of these projects allows for economies of scale. For instance, if you have a 300-unit apartment complex versus a single-family home, you can reduce cost per unit by buying labor and materials in bulk. And it's also more cost-effective to hire a professional property management company for 300 units rather than a handful of houses. In addition, you have less risk from vacancies. You can lose 5% of your tenants and still succeed. Finally, you have forced appreciation. This means increasing the property's value through improvements rather than waiting for the market value to increase organically. Due to all of these factors, the rate of return on commercial projects is much higher. It's not uncommon to see projected rates of return or IRRs of 12 to 15% with an equity multiple of 2x in 5 to 7 years. So that means I can double my money without doing any work or taking on a mortgage. That sounded like a really good option for me. So I moved 25% of my IRA into a self-directed IRA, and I invested in 4 separate projects: a self-storage development in Norman, Oklahoma, a land development project in Kyle, Texas, an apartment acquisition in Dallas, Texas, and a townhome development in San Marcos. If you're interested in learning more about how syndications work, make sure to check out my free ebook below. I'll leave a link in the description. So today my portfolio looks like this: 75% in the stock market and 25% in real estate, mostly through passive syndications. It's not perfect and I'm still learning, but it's working a lot better than the traditional approach. Let me know in the comments what's your allocation strategy. And if you want to learn more about syndications, again, make sure to check out the free ebook below. Thanks for watching, and I'll see you next time.